I'm Deborah DeBoer, Director of Professional Development at NSBAR. And today we have guests who specialize in commercial real estate. NSBAR has created a relationship with NICAR, the Northern Illinois Commercial Association of Realtors. And we want to continue that relationship. We want to strengthen that relationship. So let me introduce the people who are joining us today. One of my guests is Andy Velkme, the president, and he is president-elect of NICAR. Hello, Andy. He is a commercial real estate broker, advisor, and speaker focused on innovative real estate concepts, including, I love this, co-living, co-working, and adaptive reuse, creative mixed use, and incubation spaces. Andy, you're gonna have to tell us a little bit about what that actually means.
Sounds good, happy to.
Yeah, he partners with developers, for, investors, and owners, and he's looking worldwide for concepts and ideas that are changing the way we all use space on a day-to-day business or basis. And Andy's with Caton Commercial globally, nationally, and locally. And Andy, that's interesting. I need to know more about that. Pete Cotsirilos is a CCIM. Say it again, Pete.
Cotsirilos.
Cotsirilos. You know, I practiced that all morning and got it wrong anyway.
It's fine.
He is a longtime real estate investor, highly regarded representative, third-party buyers, sellers, landlords, and tenants. His ability to maximize underperforming real estate assets is rooted in his experience as the founding principal of a high-volume independent supermarket chain, his own real estate investing activities, and his work on behalf of third parties. Okay. He has worked in the following brokerages. You had a long career here, Pete. Coldwell Banker, National Realty, and currently KW Commercial. He's also a part of an investment company called Capital Real Estate Advisors. Jane, you are kind of an outlier in here in that you're not a broker, but you are a critical part of commercial real estate. You are Vice President of Commercial Lending at Northside Community Bank in River Woods, Illinois. You provide lending solutions to real estate owners, builders, developers, investors, and owner users in the Chicagoland area, and you've been doing it for almost 25 years. You have experience with a variety of asset classes, including multifamily, mixed use, office, retail, and industrial. You also have a lot of experience dealing with non-performing commercial real estate, an MBA in finance from DePaul University. Look at you guys. You are all really accomplished, really interesting. And I'm gonna start by saying, I am a residential broker. That's what I know and that's what I understand. And what we're looking to do here is to expand our understanding of what you commercial people do in your daily life and everything. I'm going to start with asking you this question because I get asked it all the time. Every time we have a new orientation at NSBAR, people come in and say, how do I get to be a commercial broker? How do I get to do that? Well, two questions. One is, do I need a special license to be a commercial broker? No, you need your real estate license. And how do I get to be that commercial broker? Pete, I'm going to ask you to start.
That's a good question. What do you mean by a commercial broker? That's what I would ask them. What is their thinking as what a commercial broker does? When I started in residential. I decided to go with the commercial end of it. I lasted about 1 month in residential, so I went to commercial. And the first thing I did is education. I wanted to know that I wanted to make sure that I knew everything about commercial real estate that I could in order to take care of my clients. So I started with my CCIM. I started taking classes just to learn about the commercial real estate industry. The commercial real estate industry is a lot different than residential in the fact that there's different types of commercial real estate. There's industrial, there's retail, there's office, multifamily, it goes on and on, land development. So that's what I would suggest. Decide what you want to do. If you want to get into commercial, if you want to do that, educate yourself. Find classes, whether it's be CCIM or classes from NSBAR. You have to look at this as a different type of industry. It's not the same as selling real estate, selling a home. There's a lot to it. And in order to take care of your clients, you got to make sure that you know what to look for them. Whether they're buying investment properties, or they're looking to lease something, or looking to whatever they're going to do in commercial real estate, you have to know how to help. Now, once you get into it, if you want to specialize in industrial, specialize in multifamily, that's usually what other big companies will ask you to do because they want you to be an expert in that particular area. The fact that if you go into it, my suggestion is the first thing you do is get educated and decide if they really want to do it. And another thing you got to understand too, other than leasing property, if you go into investment property, it takes a lot longer to close properties when you're going into commercial real estate than it does for residential. A lot of times I've been in transactions that lasted a year and a half, 2 years to close. So obviously it was a $13 million property that is worth the wait, but those things, it happens. I mean, it takes a long time to close. So it's not one thing after the other. You have to build build those properties or those have a bunch of properties in the tube ready to go. So that's my suggestion.
Andy, I'd like to ask you the same question. How did you get involved in commercial real estate?
I took a little different route into commercial real estate than many. I came from the world of market research. I actually worked for a global research solutions company, and we did focus groups and online communities and things of that nature for some of the world's largest brands. But then I joined a startup that was research focused and big data focused in the commercial real estate space. So I came in more from the research angle. But as I got more into the industry, I realized the importance and the distinction between commercial real estate and residential real estate. And that is basically, the analytical and the mathematical angle. Within commercial real estate, you're analyzing properties, from their investment standpoint, or if you're doing it more from a leasing standpoint in retail or restaurants, you're looking at it from the investment from the landlord side or the tenant side, which is all a factor of the rent you end up paying, also the months of abatement you might be getting, meaning free rent on the front end. Those are all levers and part of the negotiation process, unlike in the residential market, which is more about, I would say, kind of location specific comps, and then also just the emotions behind it. A lot of times the emotions drive the end pricing depending on how someone loves a property. You won't see that in commercial real estate very often because the numbers tell a story, and it's all about whether or not you're getting back, anticipated returns. And on top of the numbers too, it's a whole different vocabulary than you'd find in residential. While you still have to use a contract to close deals, you'd spend a lot more time dealing with that due diligence, expected returns, cap rates, all of those things. And super important to understand that on the front end, because without, that knowledge, you'll be stuck. And what I did first was I looked around. I found some sources that were great from an educational standpoint, including CCIM, where I took the first course. And within that week, I learned more than I had ever imagined within a week about how to analyze an investment, basically. And I took some courses within Caton Commercial that were offered, both from a sales and an analytical perspective, and then also looked towards NICAR, CAR, and other realtor organizations, which was, I think, critical to really kind of hit the ground running and not have to, spend too much time on my own digging around and hoping I found the right information. So, my recommendation is definitely to look at NICAR, look at NSBAR, look at what's offered, look a little broader, if you're looking to do investments for CCIM and so forth. And then the last thing I wanted to add too is one other distinction within the world of commercial real estate, which is quite important to understand, is that there's, a couple, besides the investment asset classes, like Peter mentioned, multifamily, industrial, retail, there's also different ways of being involved, meaning there's the investment angle when people are buying buildings for returns, whether it's, for just your personal retirement account, you're buying a small strip center, or you're part of a, institutional fund investing into huge properties. That's one angle, but there's also the user angle. That is, if you are the owner of a business and you need to lease out space in an industrial park for distribution, or you need a point of purchase, retail space. Those are different parts of the industry. And there's a different, involvement and different expectations. And understanding that and kind of figuring out what makes more sense for you is recommended. But at the same time, if you are kind of a curious type and you'd like to learn more about different parts of the industry, look more towards a smaller or a boutique type of firm, which will allow you, the opportunity to grow in different directions versus some of the larger companies, as Peter mentioned, like to really kind of hyper specialize you. So you're a true expert within one of the asset classes, but that's just, it's one of the main distinctions. And so something to keep in mind if you're getting into the industry just for commercial reasons.
Okay, thank you.
One thing I want to bring out too, in my opinion, if you're going to do residential or you're going to do commercial, I think you should specialize in one or the other, and make sure that that's that residential or commercial. But if you do both, make sure you really know both. So and the commissions and commercial differ than the commissions in residential, and the fact that if you lease a property, if you're leasing a property, or you're a tenant rep or whatever, those commissions are all over the place. There are different types. They figure it out differently. Per square foot could be percentages. So you should know that. You should know what to expect as far as getting commission, because it differs. It differs in residential and commercial. You might get a 1% commission, but the property's worth $15 million. So it's not your standard 4 or 5% or 6%. So it's a difference as far as commissions, especially in the leasing world. You should know what you're to expect on that too.
Can I further one thing that Peter just said too about that is commissions in commercial are actually part of the negotiation process. Like there's a commission that you're looking for, whether or not you get it isn't necessarily always the case. It really is just another lever in negotiations because it's a certain dollar amount attached to it. In residential, if an MLS listing says it's a 2.5% co-op, it's a 2.5% co-op. But that doesn't, that's not the case in commercial. Commercial, it really varies, and it could, depending on things that you run into through due diligence, figuring out the strength of the deal, your commission may be maybe affected by that.
Okay, thank you, Jane. Tell me, you're in a different aspect of the commercial real estate world. What attracted you? What moved you into this kind of field?
Sure. Well, so similar to the brokerage side of things, the lending side of things, consumer versus commercial varies vastly. On the commercial side, lending is very much multifaceted. There's a lot of subjectivity that goes into it. I dabbled with consumer and mortgage lending for a hot minute, a couple of times during the course of my career, only to really confirm to myself that it's just not what I have a passion for. So I, started the old school way. I started through credit training and looking at different types of commercial properties and analyzing them. And as many different types of asset classes and asset properties as you have, there's different ways to look at a deal, to structure a deal. And that really, for me, gave me a sense of creativity that I think most people don't realize really comes along in a lending environment, but it very much does. And that it enabled me during the Great Recession of 2008 through, depending on who you talk to, it enabled me to help the banks work out of a lot of those problems. So it's one thing to be able to put the money out on the street. It's a very different thing to then try to go out and collect it. And where real estate is concerned, you have to have a real fundamental knowledge and understanding of the different nuances with different assets. And what you can and can't do with them. So from construction lending to owner user lending to SBA lending, there's just so many different options. Whereas with consumer lending, you can go with a 15-year mortgage, or you can go with a 30-year mortgage. And sometimes you'll find a bank that'll give you a shorter term balloon type mortgage if you don't quite fit the secondary market mold. And that's, pretty much about it. Whereas on the commercial side, there's just a lot more options and nuances and ways to structure a deal and things that you get to see and touch.
Okay. What I'm understanding and hearing from all of you is that there's a lot of education that needs to come into play when you start doing this kind of business. There's a lot of opportunity, but there's a lot of education. And there's a lot of differences. One of the things I hear periodically is that, for example, when COVID came, well, you were mentioning the 2008, what I call the bad times it was just the bad times. But in COVID, many of us in the beginning thought, okay, are we in for trouble again? Because we've been doing this a long time, so we worried. And what happened was, I think, took many of us by surprise. Residential took off like Zoom. We had a bad month or two and then it went goofy. And it's still kind of running along on a kind of a goofy path. You commercial guys struggled a little more. But I understand that it wasn't a straight line for you. There were a lot of variables on how this market has been working for you guys. Some's doing okay, some not. So can you talk a little bit about that?
Shall I start?
Sure.
Sure.
For instance, retail. Let's look at retail. Let's look at restaurants. When COVID broke, restaurants, the sit-down restaurants were hurt, they were hurt very badly. They started doing carryouts, DoorDash. They tried to get their business back a little bit. They still were hurting. On the other hand, the carryout restaurants or the drive-through restaurants were fantastic. They were doing great. I mean, as far as their business, it was better. Pizza restaurants, that type of thing, people picking up pizzas. So there was a difference as far as, in the retail and just speaking of restaurants. As far as, and we're just speaking for the COVID period, let's say office space, people decided they're going to work from home. They're not going to go to offices. So what's going to happen to the office space? That was up in the air, and it sort of still is, but we're finding that a lot of companies are saying to their employees, they'd like to see them back in the office. They like the synergies of people working together. And as COVID was going away for a while, people started coming back to the offices. And a lot of the companies did not downsize their office. I think Andy has a little bit more of a pulse on the office industry than I do, but I do have a building that that building is completely full because I have a lot of logistics company in that building. So logistics are like going in those wildfire. They're doing great. That brings me to industrial. Industrial, because of the logistics, because of warehousing, because things have changed the way people buy, going away from retail, getting into the internet, the logistics companies are booming. So my building is full of logistic companies, and I keep it full because of that. Other office buildings are empty because they don't have the companies that I have. It's a specialized. So different areas of the economy are taking to COVID a different way. But surprisingly, overall, in the end, I think everything is coming back. People were surprised, just like residential. Not booming like residential. Some areas are booming, but the overall commercial real estate is coming back, and I people are excited about it. The Dow Jones is breaking records still. Business is not going away. It's for some reason it's in some cases has gotten better. It just depends on where you're at in the economy and what you're doing and what your industry is. So retail industry, they're still hurting. I mean, that's something that they're trying to figure out, taking empty shopping centers and empty big boxes and repositioning them, putting in entertainment centers or jump zones or whatever in the big boxes. Small boxes, they're renting to more service industries rather than retail. But it's changing. The retail landscape is changing a lot. Big shopping centers are looking to reposition and maybe make them into multifamily, or they're changing. As far as retail is the biggest change, I think. Industrial is booming, and multifamily is still very, very strong. And as far as the weaker ones, it's retail is, I think, in flux right now. So
it's going to be hard. It's kind of hard to figure out what exactly retail, as we've all been trained now to do all of our shopping online. It's going to be interesting to see what happens with, I mean, it'll be an interesting thing to watch to see what happens in retail.
What they call internet proof retailers, you know, that's the restaurants. There's something where you can't get you know, something you have to go to, fitness centers, that type of thing. That's what people are going to as far as retail. Their internet proof retail is what you're trying to get. You're trying to get those tenants in their shopping center because they're not going to be affected as much with people buying online.
I like that term, internet proof. Andy, in your bio, there were all sorts of interesting things you were doing. Can you talk a little bit about some of those interesting things you were doing and how has the market affected those?
Sure. Before I do, I'll kind of, dive into what Peter was talking about as well, because it's going to lead to my explanation making more sense on how these innovative concepts work. But, it was a very hyper location driven, effect that COVID had on commercial real estate, especially in urban centers in downtowns. As the office buildings cleared out, when companies told their employees not to come in anymore, that not just affected the office buildings, that affected the retailers in the area nearby. Dunkin' Donuts doesn't sell coffee and donuts to, they need people to sell coffee and donuts to. It's office workers and tourists. As soon as all the music venues closed down and the theaters and anything that was tourist related, that severely affected the retailers in addition to the office firms. Then even further, hotels. I mean, hotels got, in a very bad place for quite a while because there wasn't any more travel. So, without the travel, people staying at home, no office to go to, no lunch spots to grab lunch in the city, the city became a very, very empty, slow, desolate place. I'd come in once in a while to the city. My office is in Fulton Market, and it didn't matter what day I came. It felt like Sunday morning. It was just empty. You'd walk around. If there was a place open, you're the only one there. So completely, that all was affected, one item affected another. And it also drove this kind of partially panic, partially the understanding of, if I'm living in the city and everything around me is closed, what advantage is there living in the city, paying higher rents or whatnot? And that created this kind of flight to the suburbs, which drove the housing prices to what they were. People started caring more about their yards, figuring out how they could, get out and enjoy outside without having to go into public. So I read that, houses with nice landscape yards were very hot commodities, as were houses with pools. You couldn't even put in a pool last year anymore because every pool manufacturing company was booked, for 9 months out because people were buying larger plots, moving out of the city, settling in a suburb and trying to kind of create their own little oasis. So that all, one thing led to another basically. And now the question is how that will end up, going into the future. I'm now heavily involved in the office sector. I joined forces with a company called Upflex, which is a tech platform similar to Airbnb, but for co-working and flex office spaces. So allows companies to allow their employees to book through an app anywhere they want to work for the day. So as people are going back to the office, what's happening oftentimes is they're staggering their days back in the office. It could be Tuesdays and Thursdays, Tuesdays, Wednesdays, it doesn't matter. The other days, companies are still figuring out what to do. Are we going to let our employees work at home? Are we going to give them the opportunity to work closer to home, but still collaborate with team members? It's really changed that dynamic. And in fact, it's actually created new positions within companies because, there wasn't necessarily a person who was the point for distributed workforce and for understanding and monitoring people's work away from the office. Now, when there's so many people working remotely at home, there's the tech aspects to take into consideration, privacy aspects, the strength of the internet, all that. There's a monitoring of how they're doing their jobs. Are they actually working the hours they should? What's their productivity like? That's an HR component. That's a tech component. There's an operations component about getting things done. And that's like several different, executives overseeing it. So now firms are creating these kind of people and places roles, which are basically, this very tech-enabled, agile HR types with business exec experience from an operations standpoint to maintain and run this whole kind of distributed, work scenario. And that's going to affect, office usage. It's going to affect retail. Even if 75% of people come back regularly into the city to their office once in a while, revenues will be down for the coffee shops, for the lunch places, for the after hour, happy hour, casual restaurants. And that'll be adjusted. We'll see a little bit of that in rents. They may just come back to almost where they were, or, the more prime locations may be driven higher. That's all going to be a function of where we end up. And from an office building perspective, the newer office buildings, the ones built within the last 5 years, they're the ones that have the better HVAC systems, better ventilation, wider hallways, elevators that can take more capacity. They seem to be doing fine. And some of those, in fact, are drawing new leases, people relocating from buildings they just moved into 10 years ago, simply because they're way more tech forward and make people more comfortable knowing that they're a safe space throughout this kind of scenario. While a lot of the older office buildings, they have more choke points, narrower hallways, small elevators, things that people are less comfortable with. And those are the buildings right now that I have a lot of clients looking at to see how they could repurpose them, if they can do something a little bit different in them to kind of revitalize them. So that's a major distinction within that marketplace is age of building, the tech aspects of the building, and then property management. Even on top of that, it's becoming very, very tech oriented from like the whole building perspective, as well as the user experience within an office space itself. As workers come back, if they come back on staggered days, you need reservation systems within the office. Who's working at what desk? They're not going to keep the same footprint in many cases and have, everybody with their own little offices or cubicles. It doesn't make sense if you're using it once, twice, 3 times a week. So there's reservation systems now where you can reserve your desk or your private office, your meeting room before you go in. There's capacity limits. It's all much more organized now than ever before. And that's another, tech-enabled solution that's needed to make sure people understand how to do that and how to make it effective.
Okay, interesting. Jane, tell me a little bit if there's money available to do all that fun stuff.
Well, I don't know if it's a good thing or a bad thing, but unfortunately, there's a little bit too much money available right now in the banking system. There has been a lot of cash sitting on the sidelines. Just to dovetail a little bit on what Pete and Andy both said, I personally think the story on COVID is still being written. And its longer term impacts on real estate. I am not sure that we're yet in a place where we can definitively say what will or won't survive. I agree. I think industrial is going to keep going strong as people are changing their shopping habits. Unfortunately for retail, I think this has been a story that's been at least a decade, if not more, in the making. And COVID, I think just pushed along the inevitable of the big box and small box retailers. Always going to be a need for the smaller inline shopping space, for those smaller retail establishments. Obviously, cannabis is more recreational. Cannabis dispensaries are coming online. Those are anticipated to make quite an impact on real estate. But in the banking sector itself, we've seen a lot of activity. The deals that seem to be getting done there's like no middle ground. It's either the really, really strong deals or the deals that are weak and you have a value add component to them. And then you have a strong borrower stepping up to take over a quasi or even distressed piece of property and turn it around. And they're seeing opportunity there. Banks right now are flush with cash. I've heard that some of the larger banks are actually starting to charge fees on customers keeping deposits over a certain level. It's just really messing up the bank's ROIs. We can't make money if we're sitting on too much capital. So there's definitely a lot of capacity in the system, very different from the last downturn where there was a liquidity crunch. We're kind of in the opposite situation. But unfortunately, I think part of that is coupled with the fact that we've had the government funding, putting a lot of cash into the system artificially. And so it's really difficult, I think, right now to assess how businesses are going to come out of COVID. Certainly, restaurants have been impacted, hospitality. I also think that because of that, as an investor, you have operational risk. Most of the landlords that we deal with had to provide their tenants, whether they be in the multifamily, retail, office, they've had to provide their tenants some sort of rent relief. And of course, that ultimately filters down to the banks, right? Because at some point they're going to come to the bank and ask for relief as well. And so we've had to accommodate those requests. So I think there is a lot of opportunity out there, but I feel that there's some pent up demand for deals. And I think a lot of folks are sitting on the sidelines waiting really to see what will happen. Interest rates right now are at all-time lows. They can't really get any lower. Otherwise, we're going to have to start paying people money to borrow money from us. So depending on how long that lasts, it's concerning from one perspective, because all those loans that we've been putting on the books the last 18 months, and there have been quite a few of them, guess what? They're at record low interest rates. Those loans are in most cases going to reprice. There's not a ton of 30-year conventional money out there in the commercial side of things. And most deals are, 3, 5, 7 years. So when those reprice, who knows where interest rates are going to be. Interest rates impact the pricing on all real estate, commercials no exception. Office space, I think, is a big question mark right now. I know the office brokers are very bullish on office space. I hope they're right, but I think a lot of that remains to be seen.
It is so interesting to listen to you speak, all three of you, because you are talking about things that, as a residential broker, for 25 years, I knew none of these things. This is like I've entered into a whole different, literally a whole different profession. And I was thinking about both Andy and Pete, you talked about CCIM and the need for education. And as I listened to like Jane talk about banks, government, COVID, interest rates, what's going on in international markets even, all of those things that come into play are so different than I want to buy a house and I love this one. Just incredibly different. Yeah, I am impressed with the breadth of knowledge that you have to be able to succeed with this. Okay, the breadth of knowledge that they are. I think it's challenging. If you had to say, Jane, you talked about some opportunities. Pete, the greatest opportunity that you see coming down in the next 3, 6, 9, 12 months, what's the best opportunity? If I was your client, you had to recommend to me some opportunities, what would they be?
Good question. When COVID started, there were a lot of people looking for distressed properties. In other words, properties that can't pay the mortgage, or the rents are not being paid. And other than retail properties, surprisingly, those distressed properties never came to fruition. You can find distressed properties in retail, but for some reason, they've kept their value. I mean, it's not as easy to find these distressed properties as people thought it would be. I think it's because in 2008, it was a lot different. There was a recession. This is more COVID driven. It's not a recession. It's a completely different ballgame. So getting back to your question again, I went off a little bit.
Oh,
sorry.
No, that's okay. If I'm your client,
tell
me what I should be looking at right now. What should I be doing?
Yes, as far as actually, we own an investment company ourselves. So what we're looking for right now is repositioning retail big boxes. We're doing it with self-storage. We found a location where we're developing a self-storage facility, about 100,000 square feet. And we're taking an old Burlington coal factory and turning it into inside self-storage, climate control. Self-storage has been doing very, very well for years. I think a lot of people have made a lot of money on it. When you get the development on, it takes 2 or 3 years to start making money. But once you do, it's well worth it if you wait for the 5, 6, 7 years, divest yourself of that. But the cap rates, there are REITs out there, there are companies, investment companies are looking to buy these self-storage facilities, and they're paying really low cap rates, 5.5%, 5% cap rates, which means the prices are very, very high. So you get your value out of not only really leasing it up and getting a day-to-day leasing income. In the end, you sell it for big profit. So you look at what you want to do and what is the appetite of the person who's asking. Do they want to do an investment? They don't want to do a small investment. They want to look for let's say a closed restaurant, put their concept in it, change it. A lot of people are doing that. As far as investment properties, you got to know, you have to have somebody with you, or you have to know how to handle an investment property. You're taking something, the best type of investment property, in my opinion, is buying something distressed and bringing it back. We've done that before, and we were very successful at it. We bought a big shopping center out of bankruptcy, turned it around, 4 years later, sold it, and made a 25% interest on our money. I mean, it's like over 5 years. It's totally doubled our money over that period. But if you're going to do that, you have to know the product. You have to know how to run the product. A lot of these distressed properties are poorly managed. So you go in there, you have to have a good management team to go in there and turn that thing around. Whether you change the outside, get new tenants, reposition it. I mean, that takes a lot of work. It takes a lot of knowledge. And I suggest to people, if they're going to do it, get a good team behind you. If you know it yourself, fine, go ahead, do it. But you rely on the brokers too. I mean, the brokers know the market. That's what their job is. They know what is a good center, what is not a good center, what industrial property, how it's going to work, what's not going to work. They know, they have the pulse on the market. They know what's going on. So I would suggest making sure you have a good team behind you. Make sure you have the knowledge. All goes back to the knowledge. You have to know the industry, know what type of investment that you're getting into, and do it that way. Deborah.
Andy, what do you think are the most opportunities floating around right now?
I'll look at that from kind of 2 angles. One is from an operator angle. If you are in retail or restaurants and you are able to kind of get through relatively unscathed, and you have investment dollars or good relationships, there are opportunities out there to get some good high-profile space at a cost that haven't been seen in quite a while from a retail perspective. There are a lot of additional vacancies and nicely built out spaces. I've heard of a couple of restaurant opportunities where they're $300,000 to $400,000 build outs, and people are just asking for $50,000 to $75,000 key money to get in, simply because when you take that out of the space, it's oftentimes very worthless. So if you are looking to expand, that's not a bad time to do so, but strategically, and making sure you really understand the submarket. And that's where it's super important to work with your, trusted realtor, commercial realtor to help you understand those decisions. Because as I kind of explained previously, submarkets are very driven by the different elements in it. And that's the other thing then from an investment standpoint, I would really look close at the submarkets that were being redeveloped or kind of gaining traction right before COVID. The Fulton Markets of the world, or a little bit further out, even like the Kinsey corridors, if you're looking in the city, places where, there were some opportunities, but from zoning perspective, certain things were a little tougher. Municipalities have gotten a little bit more friendly to development because they understand the need to kind of spur some movement. So I guess an example of that is taking a look at all these additional outdoor spaces restaurants have that they didn't before. Before is really hard to, not hard, but a little complicated and expensive to get a sidewalk license. Now people are putting, 100-foot patios on the street, and that's okay. And they're going to let that happen, they being the city, for quite a while, because they understand they need to get, the economy back up and humming, get people out. So if you're looking at areas where that's possible, I think that's kind of an interesting play. And then also the last thing to add, this is very current. If and when the transportation bills get passed through the federal government, I've been following that closely, because oftentimes once there's additional, new highway junctions put in or new stops on train lines, any kind of very solid infrastructure spending usually is a great place to chase from a development standpoint, because you can actually have an area that had very little activity, but as soon as a new interchange or a new train station's added, it becomes very desirable, and that's an opportunity that doesn't come along very often. So I'd recommend keep an eye on that as a transportation spending bill comes to fruition in the near future, hopefully.
Jane, I'm going to ask all three of you as we come to the end of this. Words of wisdom. What would you tell someone who's really thinking? I have a feeling I have an idea of some of the things you'll say, but someone who really wants to get involved in this, who really wants to start working in commercial, they don't want to do residential. Give me just a few words of wisdom. Jane, from the banking industry, what would your words of wisdom be?
The folks that I've seen do it right have gotten on board with an expert to mentor them. I think the element of mentorship, it's just impossible to know everything you don't know. And there's so much to it. Find yourself a good mentor and learn as much as you can from that individual or group of individuals. I think that's key coming in new into a business, especially when you haven't lived through, some of the pain that we've lived through. It's real easy to be overly optimistic and wide-eyed, and that's how, unfortunately, mistakes get lost. And, we're bankers, we like leverage because we make money off of it, but you can have too much of a good thing. And the folks that are doing best right now are those that are not over leveraged.
Pete, your best advice?
Yeah, I think the mentorship program is the way to go. Absolutely. And that on top of that, education besides that. I mean, whether it be SIORs, CCIM, education and mentorship, I think, are the way to go. If you really want to get into this industry, you have to know about it and give yourself some time. You have to have some time to learn it. Knowing cap rates, knowing the ins and outs of the commercial industry is, you don't learn it overnight. I mean, you learn it by experience, and that's going to take some time. So give yourself a year. You're going to have to make sure that you know what you're getting into. And once you have that knowledge and you have that, you're comfortable with it, your mentorship program is over. You know what to do and how to do it. I think, mentorship, education, and time. That's my suggestion.
Okay. Andy?
I agree with mentorship and education without a doubt. I also think that if you're thinking about coming into the industry, make sure that you are resilient and you're okay with failure, to be honest, because you will learn the most through failure. And no matter how good you are, you will fail sometimes because, a lot of decisions end up being outside of your hands. You can do a great job, could be a great property. If the buyer in the last minute decides to invest in something else, it's nothing you did wrong. They just simply decided to allocate their funds elsewhere. And you may have just spent 6 months of your life helping them, and you have to start from square one. What you have to realize is that will happen, but it's worth it in the long run because oftentimes, the deals you get done and you invest a lot of time in, the returns are outsized comparatively speaking to residential. That is, unless you're, working in the, $5 to $10 million estate kind of market, but that's quite rare. But that being said, be prepared to learn a lot, to fail quite often, to learn from your failures, and then celebrate the successes. and just kind of do that with mentors and continuing education too. I know we talked about education from the front end to understand what's going on, but you have to stay up to date. You have to keep continuing to learn. You know, one thing I recommend too is, you know, every week spend a couple hours reading commercial real estate publications, figuring out what's happening in the markets, figuring out how one thing affects another. You really have to be able to advise your clients just from a whole almost macroeconomic level, and also from a sub-market level, what's really going on out there. Because if you take a nap on that, you'll miss the opportunities, because things do change, and they change, you know, as areas develop, as people, you know, see some upside in certain kind of assets, and you got to be quick, agile, and you got to make the move when it's time. So that's my advice.
Okay, thank you. I want to thank you all three of you for spending some time with us today. I also want to tell you how impressed, as someone who doesn't have a big depth of knowledge about commercial real estate, I'm so impressed by how much interconnectedness there is in what you're talking about. How this affects this, affects this, affects this. Sandy, what you said, you better start reading how that makes, and it has an effect on this and this. And my guess is what's happening, I know it's happening in residential, the speed at which stuff is changing is increasing. The velocity is going faster and faster. So thank you, the three of you, for being here. I appreciate all the information that you have shared with all our members. And so I wish you all a good day. Go enjoy the rest of this beautiful day. Thank you so much.
Thank you.
Thank you.